Currency is the money a country uses, like the US dollar, euro, or yen. It's what lets us buy, sell, and trade, both locally and globally. Without currency, we'd be stuck bartering, making modern commerce nearly impossible. A strong currency means your money buys more abroad. A weak one, less. This isn't just abstract, it affects your travel, the price of imports, and even your daily expenses. A strong currency makes imports cheaper and travel more affordable. A weak currency does the opposite, making imports pricier and fueling inflation. For countries, currency strength is a balancing act. Too strong and exports become expensive for foreign buyers, hurting domestic industries. Too weak and inflation rises, eroding savings and purchasing power. Governments and central banks watch these movements closely, sometimes stepping in to influence them. Why should you care? Because currency strength quietly shapes your cost of living, job market, and investment returns. It's a key indicator of a nation's economic health and global competitiveness. In short, currency strength matters to everyone, from tourists to CEOs, because it impacts what your money can buy, at home and abroad. Understanding this is the first step to grasping why the yuan's value is such a big deal. So let's dive into what's been happening with China's currency, and why the world is watching. China's currency, the yuan, has seen notable ups and downs in 2024 and 2025, especially against the US dollar. In April 2025, $1 could buy 7.35 yuan, a level that raised eyebrows. But by June, the yuan firmed to 7.1814 per dollar, its strongest in a week. This shift was partly due to a weaker US dollar, which had dropped 8.5% year-to-date. When the dollar weakens, other currencies like the yuan appear stronger. There are two main versions of the yuan: the onshore yuan, CNY, tightly controlled within China, and the offshore yuan, CNH, which trades more freely in places like Hong Kong. In April, speculative pressure pushed the offshore yuan to 7.43 per dollar, creating the largest gap with the onshore rate in over a decade. This signaled market stress before interventions helped close the gap. Late 2024 saw rumors that Chinese authorities might let the yuan weaken to boost exports and counter deflation, especially with new US tariffs looming. Some analysts speculated about a target of 7.5 yuan per dollar, but as 2025 progressed, China's central bank signaled a focus on stability, not deliberate depreciation. The yuan's movements reflect a tug-of-war between market forces, policy decisions, and global events. Each shift tells a story about China's economic priorities and the pressures it faces. The world's attention is fixed on how China manages these challenges. The next scene explores the central bank's crucial role in this balancing act. Let's see how the People's Bank of China keeps the yuan in check and what that means for the global economy. The People's Bank of China, PBOC, is the country's central bank and the main force behind the yuan's stability. China uses a managed float system. Each day, the PBOC sets a midpoint for the yuan's value against the US dollar, allowing it to trade within a narrow band. This daily fixing signals the PBOC's intentions and helps guide market expectations. In 2025, the PBOC took clear steps to stabilize the yuan, especially after new tariffs and speculative pressures. Tools like the counter-cyclical factor were used to prevent sharp swings and keep the currency from weakening too much. The PBOC's message is clear. Stability comes first, not competitive devaluation. Officials argue that weakening the yuan would hurt domestic confidence and undermine efforts to make the yuan a global currency. The PBOC's actions are closely watched by markets worldwide. Their approach is about balance, supporting trade, managing inflation, and building trust in the yuan. The next scene looks at how US-China relations shape the currency's fate, and why interest rates matter more than ever. US-China trade tensions have a direct impact on the yuan. When tariffs rise, markets expect China might let the yuan weaken to offset the cost. But the PBOC has mostly chosen stability. Devaluation risks capital flight and damages confidence, so China treads carefully. Interest rate differences, known as the yield spread, also play a big role. For a while, US rates were much higher than China's, putting pressure on the yuan. But by mid-2025, the gap narrowed as US rates fell, and China's stayed relatively steady. This narrowing makes yuan assets more attractive and supports the currency. The interplay of trade policy and interest rates keeps the yuan in the global spotlight. As the US Federal Reserve signals rate cuts, the yuan's prospects could shift again. The next scene compares today's situation to the last big trade war. What's different this time, and what can we learn from the past? The 2018 to 2019 US-China trade war saw the yuan fall from 6.27 to 7.18 per dollar, a 14.5% drop. Back then, the US dollar was surging, and the Federal Reserve was raising rates, putting extra pressure on the yuan. The current landscape is different. The Fed is now expected to cut rates, and the dollar is weakening. Tariffs today are even higher, and recession risks in the US are greater. Chinese companies are better prepared, having diversified supply chains and increased the use of the yuan in trade. Some firms have shifted production abroad to dodge tariffs. The yuan is now used more in international transactions, reducing reliance on the dollar. These changes give China more flexibility in managing its currency. The yuan's response this time may not mirror the past. China's evolving strategy and global shifts are reshaping the currency's role. The next scene explores why some still see the yuan as vulnerable, and what's fueling those concerns. Let's dig into the arguments for a weaker yuan and see if they hold up. Stay tuned. Some analysts argue the yuan is vulnerable, pointing to periods of depreciation and reports of officials considering a weaker currency. Slower growth, weak trade data, and reduced foreign investment have fueled these concerns. The idea of a currency war resurfaces whenever trade tensions spike, with some suggesting China could devalue to offset tariffs. Subtle shifts in official language, like omitting basically stable from statements, add to speculation about policy changes. But is this vulnerability real or just market anxiety? The next scene offers a different perspective. Many experts argue the yuan is not fundamentally weak, but actively managed for stability. The PBOC's quick interventions in 2025, especially during speculative attacks, show a commitment to preventing disorderly depreciation. The yuan has even strengthened at times thanks to increased demand for Chinese assets and signs of domestic economic stabilization. Exporters converting dollars to yuan and consistent official messaging reinforce confidence. The focus is on keeping the yuan basically stable at an adaptive level. This approach aims to anchor expectations and build trust. The yuan's strength isn't just about its rate against the US dollar. China tracks the CFET's RMB index, which measures the yuan against a basket of major trading partners' currencies. In April 2025, the yuan stayed steady against the dollar but fell 2.7% on the CFET's index as the dollar weakened globally. This wasn't deliberate devaluation, just a side effect of focusing on the dollar rate. Managing a currency in a globalized world means balancing multiple relationships. Judging the yuan's strength requires a broader view than just the USD-CNY rate. The final scene brings it all together. Is the yuan weak? The answer is complex. The PBOC manages the yuan carefully, aiming for stability amid global pressures. In 2024 to 2025, China resisted sharp devaluation, and the yuan even strengthened when the dollar weakened. Most analysts expect the yuan to trade in a stable range, with some potential for modest gains if trade tensions ease. The evidence points to a strategy of managed stability, not deliberate weakness. The yuan's future will depend on both domestic priorities and global shifts. For now, China's currency remains a carefully balanced act, and the world will keep watching.